Welcome back to the deep dive. Today we've got something really special. It's one of the most interesting analyses I've seen in a while. A really structured five-part deep dive into a Q3 2025 earnings report.
And this one is a wild ride.
It really is. The company is SharpLink Gaming, ticker SBET. And this report, well, it didn't just show a good quarter, it completely redefined what the company even is.
That's the perfect way to put it. I mean, if you just read the headlines, you see this massive, spectacular financial beat. But taking those numbers at face value, you would completely miss the point.
You'd misunderstand everything. The risk, the future, why it's even set up this way.
Right. This is not a simple story about a gaming company that suddenly got really good at selling its product. It's something else entirely.
Exactly. So our mission today is to get way beyond those headlines. We're using this really rigorous analysis. It pulls in the company's official data, checks it against market consensus, uses real-time info to decode why the market was so wrong.
And what this company has actually become. Because the consensus estimates were based on the old SharpLink.
The small-cap gaming and marketing company.
Yes. But the results that came out, they were generated by the new SharpLink, which is basically a sophisticated digital asset treasury manager. And the gap between those two models is where you get this crazy 1,100% revenue pivot.
A pivot of that size is just, well, it's staggering. So if you want to understand how a company can do this, how it can change its identity in a single quarter, this is for you. We're going to walk through the analysis slide by slide. Now for slide 1, the at-a-glance scorecard.
Okay, so this scorecard is the first shock to the system. The analysis calls the results a fundamental surprise, and that's not an exaggeration. It's not about just beating expectations.
It's about making the expectations look completely irrelevant.
Exactly. Let's start with revenue. The consensus estimate, so what analysts were predicting, was a pretty modest $3.414 million for the quarter.
Right, based on their old gaming business model.
But what they actually reported was $10.8 million.
Oh, more than triple.
More than triple. The analysts weren't just off by a bit, they were off by a factor of 3. That kind of miss tells you something new and powerful has been plugged into the income statement.
And then we get to the bottom line, the profitability. This is even more shocking. Wall Street was expecting a loss.
A loss, yes. A fully diluted earnings per share, or EPS, of minus about 3.5 cents. They were supposed to be burning cash.
Instead,
They reported a positive EPS of 62 cents. A profit.
so that's a swing of over 65 cents per share. From an expected loss to a really substantial profit. I mean, that just screams that something fundamental has changed.
It does. But here's the first clue that something is, let's say, unusual about this profit.
The market reaction.
The market reaction. Despite this absolutely stunning beat, the stock only went up about 2.77%. It closed at $11.75.
Which is, that's so muted. If a normal company tripled revenue and did that kind of profit swing, you'd expect a 20, maybe 30% pop in the stock price.
For sure. And that quiet reaction is the market hitting the pause button. You know, investors saw the headline and they immediately asked, wait a second, where did this money actually come from? They didn't trust it.
They knew they had to read the footnotes.
And that's where you see the year-over-year transformation data. And it just confirms this isn't the same company.
Let's lay out the raw numbers.
Yeah.
Q3 2025 revenue, $10.8 million.
And you compare that to the year before, Q3 2024, when revenue was just $900,000.
$900,000 to almost $11 million. That's that mind-bending YoY growth rate of plus 1,100%.
And the net income story is even crazier. In Q3 of 24, they had a net loss of about $885,000.
And in Q3 of 25,
A net income of $104.3 million.
a $100 million swing. It's incredible. Now, this is a good moment to explain for our listeners why we keep saying diluted EPS instead of just basic EPS.
It's a really critical difference, especially here.
Yeah.
So basic EPS is the simple calculation. You take the net income divided by the shares that are currently out there on the market. That's it.
Your piece of the pie as it exists today.
Right. But diluted EPS is the much more conservative number, the one pros focus on. It says, okay, what if every single stock option, every warrant, everything that could become a share in the future, do so right now?
I like the pizza analogy they use in the analysis for this.
It's a great one. Think of that $104.3 million in net income as a giant pizza. Basic EPS says, okay, we've cut 10 slices, so each share gets 1/10.
But diluted EPS sees that the chef, or management in this case, handed out a bunch of vouchers that let people claim 5 more slices if they want them.
Exactly. So even if those vouchers haven't been cashed in yet, Diluted EPS forces you to divide that same pizza by 15 potential slices, not 10.
So each slice is smaller. The EPS figure is lower, more conservative.
It's a stress test.
Yeah.
And if a company can still report a strong profit, like $0.62 under that what-if scenario, it's a much more powerful statement about their financial health.
Okay, so that brings us to the core mystery, the mathematical anomaly. How do you report $10.8 million in revenue and somehow generate $104.3 million in net income? Profit can't be 10 times your sales.
It can't. And this is where the pivot is laid bare. The answer has two parts. The first, and the biggest driver, is factor one, mark-to-market gains on crypto assets.
So this is an accounting rule.
It's a U.S. gas rule, yeah. When a company holds assets like crypto, in SharpLink's case, a huge amount of Ethereum, or ETH, they have to measure it at its fair market value each quarter.
And they hold a lot, 817,747 ETH.
A massive amount. And during Q3, the price of ETH went up. A lot. So the accounting rules say they have to report that increase in value.
As if it were income, even though they didn't sell a single coin. They didn't get any cash for it.
Correct. It's an unrealized, non-cash, non-operational paper gain, but it flows directly to the net income line. And that is where the vast majority of that $104.3 million came from. Not from a customer, but from the crypto market.
I have to stop you there because this is the critical risk point, isn't it? If that profit isn't real cash they earned, does that mean if the price of Ether tanks next quarter, they have to report a massive loss?
That is the absolute heart of the matter. And yes, they will. If Ether drops, GAAP will force them to report a mark-to-market loss, an unrealized paper loss, and it could easily swing them back into a huge reported deficit even if their gaming revenue grows.
So the profit quality is completely different. It's not recurring. It's volatile financial exposure.
It's pure financial exposure.
Yeah.
And then that gets amplified by factor two, strategic share repurchases.
This is the financial maneuver that juices the final number.
Right. Remember, EPS is net income over shares outstanding. We know the numerator, the income, is huge because of the paper gain. Well, during the quarter, SharpLink also attacked the denominator. They bought back and retired almost 2 million of their own shares for about $31.6 million.
So you have this huge non-cash profit on top, and you're dividing it by a smaller number of shares.
And that inflates the final EPS figure even more. It's a highly engineered but perfectly legal result. The whole beat is an accounting and financial strategy story, not an operational one.
Moving to slide 2, the engine of profitability. Normally we dig into gross margins here, but the report says we don't have that data. What we can calculate, though, is the net profit margin.
And this calculation really proves the point we were just making. So to get the net profit margin, you take net income, the $104.3 million, and you divide it by total revenue, the $10.8 million.
And what you get is a net profit margin of 965.7%.
965%. That number is, it's an absurdity in any normal business context.
It's definitive proof. It means for every dollar they made in sales from their actual business, they somehow generated $9.66 in pure profit, which is impossible.
It's a mathematical impossibility. It just confirms that profitability is completely 100% decoupled from their operational revenue. The engine of profitability isn't the gaming division.
It's the Treasury Department managing billions in crypto.
Exactly. Now, this brings up a really important point for investors looking at high-growth stories. When you see revenue exploding like this, the first thing you think of is operating leverage.
Right, and we need to explain why that's the totally wrong assumption here.
It's so critical. Operating leverage is all about how efficiently you turn extra revenue into profit. It's about your cost, structure fixed costs versus variable costs.
A classic high-leverage business is something like a software company, right?
A software company or a toll booth. You spend a ton of money up front, the fixed cost, to build the software or the road. But once it's built, the cost to serve one more customer, a new user, or another car
is almost zero.
It's close to zero. So every new dollar of revenue flows almost entirely to the bottom line. That's high leverage. That's scalability.
And a low-leverage business is more like a grocery store.
Perfect example. To sell more milk, you have to buy more milk. Your variable costs are high, profit grows, but it grows steadily with sales, not exponentially faster.
So a lazy analyst sees SharpLink's 1,100% revenue growth and thinks, aha, they finally hit that leverage point with their gaming platform.
That would be the assumption. But it's dead wrong. The real leverage at SharpLink isn't operational. It's financial leverage to the price of a single asset, Ether.
And that's a completely different risk profile.
Completely. Their future performance doesn't depend on signing up new gaming clients. It depends on crypto market fluctuations. Their engine of profitability is that $3 billion crypto treasury. The company's DNA has changed.
Now for slide 3, financial strengths and shareholder rewards.
And if you look at their balance sheet, it just confirms this new identity. The analysis calls it a crypto-native fortress, and that's really what it is. This doesn't look like a gaming company's balance sheet anymore.
Let's break down the key assets. The big one is obviously the crypto.
It's the foundation. Roughly $3.0 billion in crypto assets. That's the core. Then they have about $26.7 million in USDC stablecoins.
Which are pegged to the US dollar. Why hold those? For stability.
For stability and liquidity. It's their working capital.
Yeah.
If they need to pay a bill or buy back stock, they can use the stablecoins without being forced to sell their ETH at a bad price. It's a buffer.
And then just $11.1 million in actual cash for day-to-day stuff. So the takeaway is clear. If you own this stock, you are making a direct, powerful bet on the price of Ether.
That's the investment thesis in a nutshell. You're not betting on fan engagement software anymore.
And they're not just sitting on these assets. They announced a really aggressive capital return policy, a huge buyback.
This is where their confidence in the strategy really shines through. The board authorized a $1.5 billion stock repurchase program.
$1.5 billion. For a company this size, that is a massive signal.
It's a huge signal that management believes their stock is deeply undervalued. And they didn't just talk about it, they acted on it immediately, buying back over $31 million worth of shares in the quarter.
The co-CEO, Joseph Chalom, had a quote that just nails their thinking here. He said, "We've doubled our ETH per share concentration from 2.0 to 4.0 since inception of the Treasury."
And that quote is the key. It shows they view their own stock through the lens of its net asset value, or NAV. They believe the stock is trading on the market for less than the value of the ETH it represents.
So if the ETH behind one share is worth, say, $15, but the stock is trading at $11.75,
then buying back their own stock is the most profitable thing they can do with their capital. It's what they call an accretive maneuver.
explain that. What does that mean for a shareholder?
It means that every time they buy back a share and retire it, the total pool of ETH, that $3 billion, is now divided among fewer remaining shares. So your personal slice of that pie gets bigger.
So even if the price of Ether goes nowhere, my investment is becoming more valuable just because they're concentrating my ownership.
That's it, exactly. They're telling the market, we believe in this ETH strategy and we think our own stock is the cheapest way to get exposure to it. It's a very powerful two-pronged approach.
Moving now to slide 4, the road ahead management's outlook and key takeaways. This section really closes the door on the old company. I mean, management's commentary doesn't even really mention the gaming business. It's all about their new identity and digital assets.
The co-CEO, Chalom, defines their new model as pioneering a new model for publicly traded ETH treasury companies. He says it marries the agility of an active asset manager with the transparency of a public company.
That's a very specific mission statement. They're basically offering themselves as a regulated, publicly traded way for big investors to get sophisticated exposure to Ethereum.
And a key word in there is active. They're not just passive holders. They're not just going to sit on the ETH and hope the price goes up.
They're actively managing it.
Yes. They're pursuing sophisticated compounding yield strategies. Their goal is to actually grow the number of ETH coins they hold, not just benefit from price appreciation.
And they gave a very specific, very technical example of how they're doing that. They're deploying $200 million of their ETH.
Right, onto something called Consensus Linea, and they're using tools called Ether.ai and EigenCloud.
Okay, we have to unpack that. What does that mean in simple terms?
So Linea is what's called a layer 2 network for Ethereum. Think of it as a faster, cheaper express lane built on top of the main Ethereum highway. Moving assets there shows they're technically savvy.
Okay, so they're operating more efficiently. Where does the yield or the extra return come from?
That comes from Ether.fi and EigenCloud. Essentially, they are staking their ETH, which is like putting it to work to help secure the network in exchange for rewards. But they're using a technique called liquid restaking.
So they get a token back that represents their staked ETH, and that token can still be used. Their capital isn't totally locked up.
You got it. And then with EigenCloud, they take that token and they restake it again to secure other parts of the ecosystem, earning another layer of yield on top of the first.
It's yield stacking. They're earning a return and then earning a return on that return.
It's the definition of a sophisticated compounding strategy. And it proves they aren't a gaming company anymore. They are a definitive financial institution that just happens to be publicly traded. Their whole bet is that this institutional supercycle for Ethereum is coming, and they're positioned to be the go-to vehicle for it.
So let's wrap this all up with the key takeaways from the analysis. Takeaway 1, the pivot is complete and validated.
No question. The Q3 results confirm it. The company's performance is now totally decoupled from gaming and tied directly to the price of Ether and their ability to execute these complex DeFi strategies.
Takeaway 2, decoding the beat is everything.
The huge earnings beat wasn't an operational miracle, it was an accounting and strategic event, driven by those mark-to-market paper gains. The quiet stock reaction shows the market is still trying to figure out how to value this new hybrid model.
And finally, takeaway 3, a two-part shareholder value strategy.
It's a brilliant two-pronged assault. Part 1 is grow the pie. That's the active DeFi management using yield stacking to increase their total ETH holdings.
And part 2 is concentrate the pie.
That's the $1.5 billion buyback program. Reducing the share count to make sure each investor's claim on that growing pile of assets gets bigger and bigger.
So the final story here isn't about a gaming company's surprise success. It's about a planned, radical, and so far successful pivot into a new asset class. The earnings beat was the validation of that entire strategy.
It completely redefined the investment thesis for SBET way. You're no longer buying a speculative gaming stock. You're buying a leveraged, actively managed, transparent bet on the future of the entire Ethereum ecosystem.
Okay, let's bring this back home for our listeners. The big lesson here is that you simply cannot trust the headline numbers when a company is transforming this dramatically. The $104 million profit didn't come from selling a product.
It came from an accounting rule being applied to an asset they hold.
And understanding that difference is everything. It's the difference between a smart investment and just completely misreading the risk you're taking on.
And it raises a really interesting bigger picture question for you to think about. When a company pivots this hard and its whole business model is new, how long should Wall Street keep using the old consensus estimates? I mean, does the old forecast even matter anymore?
That's a great question. When is the old data just obsolete?
Right. How do you value a company like this? It's part treasury, part active DeFi fund, part public company. The market is still figuring that out. It's definitely something to mull over.
And that wraps up our deep dive on SharpLink Gaming's Q3 2025 financial transformation.
Before we go, we need to provide some important context.
Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional.
AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.